Brad Williams. Frugal finance, return on capital, return on equity, net present value, and internal rate of return. The return on capital on a project measures the returns earned by the company based on its total capital contribution in the project. Consequently, it is a return to all claim holders in the company on their collective contributions in a project. Find generally return on capital pre-tax, earnings before interest and taxes, divided by the average book value of capital invested in project. Return on capital after tax equals earnings before interest and taxes times 1 minus tax rate divided by average book value of capital invested in project. To illustrate, consider a 1-year project with an initial capital contribution of $1 million and earnings before interest and taxes of $300,000. Imagine that the project has a salvage value at the end of the year of $800,000 and that the tax rate is 25%. In terms of timeline, the project has the following inputs. Earnings before interest and taxes equals $300,000. Book value, $1 million. Salvage value, $800,000. Average book value of capital, $1 million plus $800,000 divided by 2, $900,000. The pre-tax and after-tax return on capital can be calculated as follows. Return on capital, pre-tax, EBIT divided by total capital equals 33%. Return on capital, $300,000 or 75% of this earnings, 25%. Even though this calculation is rather straightforward for a 1-year project, it becomes a little more complicated for multi-year projects where both the operating income and the book value of the project change over time. In these cases, the return on capital can either be calculated each year and then averaged over the time, or the average operating income over the life of the project can be used in conjunction with the average capital contribution during the period to determine the average return on capital. The after-tax return on capital on a project has to be compared to a hurdle rate that is defined consistently. The return on capital is calculated using the earnings before debt payments and the total capital invested in a project. Thus, it can be viewed as a return to the company rather than just to equity investors. Therefore, the cost of capital should be used as the hurdle rate. If the after-tax return on capital is greater than the cost of capital, do the project. If the after-tax return on capital is less than the cost of capital, don't do the project. That's what it is. And I've shown a couple of different examples, and I'll continue. In this example, if the company considering this project had a cost of capital of 10%, it would view the investment in the new project as a good one. Estimating and using return on capital in decision making, capital construction, self-storage project. Example 1.5, we computed the operating income on constructing a self-storage facility by Capital Construction Company. We will calculate the return on capital on this project using our earlier estimates of operating income. Worksheet 1.14 summarizes the estimate of operating income and the book value of cap for this project. We have after-tax operating income, $497, and then $377. They're doing all this work. They're taking all this risk. We get a payment here, more outflow, more outflow, more outflow. Payment, outflow, outflow. Project done. Big inflow. Total $135. We're going to net out that difference. I suspect if we add this thing up, it would be $135. Then we have this book value capital, and I do all these calculations. So we have a return on capital of 13.96. What is that? That's $135 divided by the average book value of capital. What's the book value capital? There was a 25-75 ratio here, 25% debt, 75% equity. Capital Construction should have asked for ownership. They should have asked for some shares in this LLC or in this company because they were assuming all of the risk. Now keep in mind, the owner might also own Capital Construction. This is not unusual. They just subbed out the construction and they own the facility. The book value of capital each year includes the capital contribution in fixed assets and the non-cash working capital. If we average the year-specific returns on capital, the average return on capital is 13.96 right here. But this number is pushed up by the extremely high return in month 12. Better estimate of the return on capital is computed by dividing the average after-tax operating income, 109,176, over the 12 months by the average capital invested, 1.467 million over this time, which yields a return on capital of 7.44%. Because this number is well below the cost of capital of 12.9% that we calculated in example 1.4 for this project, the return on capital approach would suggest that this is a bad project. Return on equity. The return on equity generally looks at the return on equity to investors using the accounting net income as a measure of this return. We generally define this as return on equity equals net income divided by average book value of equity in project. As an example, consider a 4-year project with an initial equity investment of $800. And the following estimates of net income in each of the 4 years. Of this contribution, we also show this 140, and I suspect that would be the cash flow. Like the return on capital, the returns on equity tends to increase over the life of the project as the book value of equity project is depreciated. Just as the correct comparison for the return on capital is the cost of capital, the correct comparison for the return on equity is the cost of equity, which is the rate of return equity investors demand. A project's risk profile and the amount of debt the company has taken on should be explained by the cost of equity. A project with a higher return on equity will be looked at as more favorable when selecting amongst mutually exclusive projects with comparable levels of risk. Net present value, the sum of the present values of the expected cash flow on the project net of initial funding. The full estimate of cash flows described earlier in the section requires subtracting out CapEx and changes in non-cash working capital, but it is way too volatile on a year-on-year comparison to get a reliable measure of returns on equity or capital. Discounted cash flows, most decision rules based on discounted cash flows not only replace accounting income with cash flows, but explicitly factor in the time value of money. The two most widely used discounted cash flow rules are net present value and the internal rate of return. Net present value, the net present value of a project is the sum of the present values of each of the cash flows, positive as well as negative, that occur over the life of the project. Formula for net present value equals net present value summation of cash flows divided by 1 plus R minus the initial funding, where C of S is cash flow in period T, R is the discount rate, and N is the life of the project. Right here. We use these numbers, consider a project which is an initial funding of $1 billion and expected cash flows of $300 million in year 1, et cetera, et cetera. We discount this back. We're going to assume 12%, so we discount the 268 cash flow there, and we have this negative net present value. Once the net present value is computed, the decision rule is extremely simple because the hurdle rate is already factored in the present value. Decision rule, if the net present value is greater than 0, accept the project. If net present value is less than 0, reject the project. Note that an MVP that is greater than 0 means that the project makes a return greater than the hurdle rate. Our hurdle rate is 12%. Not in this case because we have a negative net present value. If this was positive, if it was 0, what's the rate of return we're earning? Net present value from the company's point of view, capital construction, self-storage facility. Worksheet 1.15, we calculated the present value of the cash flows to capital construction. As a company from the proposed construction of a self-storage facility, the cost of capital 12.9% as the discount rate on the cash flows. The cash flows are shown in example 1.15 and the cost of capital is shown in 1 point something. All right, don't worry about this numbers here. Here we have the 497,814. Here's the numbers. Here are the numbers discounted. You can see we have a huge net 162,378,355. In this particular case, the project has a net present value of negative 876,928, suggesting that it is a project that should not be accepted based on the projected cash flows and the cost of capital of 12.9%. Properties of the net present value. The NPV has several important properties that make it an attractive decision rule and the preferred rule, at least if corporate finance practitioners were doing the picking. NPVs are additive. The NPVs of separate projects can be combined to arrive at a cumulative net present value firm or division. No other project decision rule has this property. The property itself has a number of implications. The value of a company can be written in terms of the present values of the cash flow of the project that it has already taken on, as well as the expected net present value of prospective future projects. The value of company equals the summation of the present value of projects in place plus the NPV of future projects. The first term in this equation captures the value of assets in place, whereas the second term measures the value of expected future growth. That's what this is all about, is determining the future growth. Note that the present value of projects in place is based on anticipated future cash flows on these projects. So when a company terminates an existing project that has a positive present value based on anticipated future cash flows, the value of the company will increase by that amount. Similarly, with an investment in a new project with an expected negative net present value, the value of the company will decrease by that amount. When a company divests itself of an existing asset, the price received for that asset will impact the value of the company. If the price received exceeds the present value of the anticipated cash flow on the project to the company, the value of the company will increase with the divestiture, otherwise it will decrease. When a company invests in a new project with positive net present value, the value of the company will be impacted depending on if the NPV meets expectations. For example, a company like Apple is expected to take on high positive net present value projects, and this expectation is built into the value. Even if the new project taken on by Apple has positive NPV, there may be a drop in value if the NPV does not meet the high expectation of financial market. A business will lose value if it makes an acquisition and pays a price greater than the present value of the anticipated cash flows from the target company. This is the same as taking on a net negative present value project. Immediate cash flows are invested at the hurdle rate. Hurdle rate, the minimum acceptable rate of return that a company will accept from taking a given project. Implicit in all present value calculations are assumptions about the rate at which intermediate cash flows get reinvested. The net present value rule assumes that intermediate cash flows on a project, that is, cash flows that occur between the initiation and the end of the project, get reinvested at the hurdle rate, which is the cost of capital if the cash flows are to the company, and the cost of equity if the cash flows are to equity investors. Given that both the cost of equity and the capital are based on the returns that can be made on the alternative project of equivalent risk, the assumptions should be reasonable. Net present value calculations allow for interest rate shifts. In all the examples throughout this section, we have imagined that the discount rate remains unchanged over time. This is not always the case. However, the net present value can be computed using time-varying discount rate. The general rule for the net present value is net present value of project equals the summation of cash flows and then 1 plus R divided by minus initial funding, where C of F is cash flows in period, R is one period discount rate that applies to project T, N is the life of the project. The discount rate may change for 3 reasons. The level of interest rates may change over time, and the term structure may provide some insight on expected rates in the future. The risk characteristics of the project could possibly change in a predictable way over time, resulting in big changes in the discount rate. The financing mix on the project may change over time, resulting in changes in both the cost of equity and the cost of capital. Net present value calculations with time-varying discount rates. The present value of each of the cash flows should be computed as shown below. 400, this is year 1, 400 divided by 1.12. 500 divided by 1.12 times 1.13. So you get this pattern here. What I have is this calculation right here. See this? In the end, the net present value of the project is $589.94. Internal rate of return, the rate of return earned by the project based on cash flows, allowing for the time value of money. Internal rate of return is centered on discounted cash flows. Unlike the net present value rule, though, it takes into account the project scale. It is the discounted cash flow analogy to the accounting rates of return. So generally speaking, the IRR is the discount rate that makes the net present value of a project equal to zero. As an example, let's look at the project described at the beginning of this net present value discussion. We have this cash flow. If you look here, all we do in terms of net present value, we're going to keep in mind, this is discounted. If this wasn't discounted, can you calculate this another way? You may be able to use the net present value tool. Think about that. I'm not going to do it now. Just use net present value. The net present value is the summation of this information here. Now keep in mind, I shortcut, I should have put 1,000 up top here, but it doesn't matter. The computation just shows the initial outflow plus the discounted cash flows comes up with this 589. In terms of the internal rate of return, we're just going to use these numbers. All you have to do is put in IRR and then just capture the information, and it's going to give us this internal rate of return. This is annual rate of return to 36.44%. I want that investment. There's only a few companies that earn that type of return, and that would be companies like Microsoft and Apple. And as the internal rate of return, the net present value of the project is zero. The linkage between net present value and the internal rate of return is most obvious when the net present value is graphed as a function of the discount rate in a net present value profile, as the NPV profile for the project describes is illustrated in image 5. So you can see the discount rate. Many intriguing details about the project's viability can be found in the net present value profile. First, the graph makes the internal rate of return, i.e. the point where the profile crosses the x-axis, obvious. It serves as a gauge for the net present value sensitivity to changes in the discount rate, which in turn affects the project's decision. The project discount rate sensitivity is indicated by the net present value's profile slope. Third, graphing both the NPV profile together gives an indication of the break-even discount rate. That is the rate at which the decision maker will not care which of the two projects they're reviewing when mutually exclusive projects are being evaluated. Using the internal rate of return, one advantage of the IRR is that it can be used even in cases where the discount rate is unknown. While this is true for the calculation of the IRR, it is not true when the decision maker has to use the IRR to decide whether to take a project. At that stage in the process, the IRR has to be compared to the discount rate. If the IRR is greater than the discount rate, the project is good. If it's less than the discount rate, the project is bad. The IRR, like the NPV, can be calculated in one of two ways. The IRR can be calculated based on the free cash flows to the company and the total capital contribution in the project. In doing so, the IRR has to be compared to the cost of capital. The IRR can be calculated based on the free cash flow to equity and the equity contribution in the project. If it is calculated with these cash flows, it has to be compared to the cost of equity, which should explain the riskiness of the project. If the IRR is greater than the cost of capital, accept the project. If the IRR is less than the cost of capital, reject the project. If the IRR is greater than the cost of equity, accept the project. Otherwise, if the IRR is less than the cost of equity, reject the project. When choosing between projects of equivalent risk, the project with a higher IRR is viewed as the better project. Estimating the IRR based on free cash flow to the firm, capital contribution, the cash flow to the company from capital construction are used to arrive at a net present value profile for this project in image 1.6. The IRR in dollar terms on this project is 10.35%, which is lower than the cost of capital of 12.9%. These results are consistent with the findings from the NPV rule, which also recommended not to construct the self-storage facility. Biases, limitation, and caveat. The IRR is the most widely used discount cash flow rule in project analysis, but it does have some serious limitations. Because the IRR is a scaled measure, it tends to bias decisions which are much more likely to yield higher returns and away from larger ones. There are a number of scenarios in which the IRR cannot be computed or is not meaningful as a decision tool. The first is when there's no or only a very small initial capital contribution and the cash flows are spread out over time. In such cases, the IRR cannot be computed, or if computed, is likely to be meaningless. The second is when there is more than one internal rate of return for a project and it is not clear which one the decision maker should choose. Multiple IRRs. Consider a project to manufacture and sell a consumer product with a hurdle rate of 12% that has 4-year life and the following cash flows over those 4 years. The project, which requires the licensing of a trademark, requires a large payment at the end of the 4th year. Image 1.7 shows the cash flows. So we have an initial negative million, positive 8, positive 1,000, positive 13, and negative 2,200. Using this example, this is what happens when internal rate of return output. Why? Because IRR just can't handle multiple negative inputs. You could throw the negative 2,200 just before 800. It'll compute the internal rate of return, but you're biasing the outcome because your cash flows are going to be irregular. Your internal rate of return could be skewed. The project has 2 IRRs, as you can see, 6.6 and 36.55. The choice of which IRR to use will affect whether or not to accept the project because the hurdle rate lies somewhere between these 2 internal rates of return. That's a big spread. The decision maker would need to consider the net present value profile in order to decide appropriately in this situation. The project ought to be approved if, as in this instance, the net present value is positive at the hurdle rate. The project ought to be turned down if the net present value is negative at the hurdle rate. Multiple internal rates of return, why they exist and what to do about them. The IRR can be viewed mathematically as a root to the present value equation for cash flows. In the conventional project, where there is an initial capital contribution and positive cash flows thereafter, there's only one sign change in the cash flows and one root. That is, there's a unique IRR. When there's more than one sign change in the cash flows, there will be more than one IRR. In image 1.7, for example, the cash flow changes signs from negative to positive in year 1 and from positive to negative in year 4, leading to 2 IRRs. Note that many long-term projects require significant reinvestment at intermediate points in the project, and that these requirements may cause the cash flow in those years to become negative, lest this be seen as some bizarre artifact that is unlikely to happen in the real world. The IRR approach could counter difficulties when this occurs. There are a number of solutions suggested to the multiple IRR problem. One is to use the hurdle rate to bring the negative cash flow from intermediate periods back to the present. Another is to construct a net present profile. In either case, it is probably much simpler to calculate and use the net present value. Capital construction, self-storage decision, initial rate of return, IRR 10.35. If the project net present value is positive, accept the project. Project net present value, if the project net present value is negative, reject the project. EBIT, book value, capital N, book value, after-tax return on capital, 7.44. If the after-tax return on capital is greater than the cost of capital, accept the project. The cost of capital is 12.9%. If the after-tax return on capital is less than the cost of capital, reject the project. This is a rejection. Book value of equity, end and beginning of project, book value equity average, 497,739. Return on equity, and I didn't compute these. I'm just grabbing the information from other examples. If the return on equity is greater than the cost of equity, accept the project. What's the cost of equity? 15.45. What's the return? 8.8. If the return on equity is less than the cost of equity, reject the project. You reject the project. And then the rest of this information is just redundant. I just grabbed this from other examples. Brad Williams, Frugal Finance. Thanks for watching.